Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And welcome to today's episode, all about last night's federal budget. Wow, it's a whopper. There's some huge changes in the budget. So what I'd like to do is go through those changes in this episode, and no doubt once the dust settles and once there's more debate and I think things become clearer, that there's no doubt I'll be unpacking many of these changes on the podcast. So certainly stay tuned and rest assured that we'll be looking at all these things very closely, and I'll be sharing our thinking, our internal thinking at Pro Solution, what we're doing with clients, and we'll certainly share that along the way because we all need to kind of navigate these changes, I guess. But the first thing to say is they're not law, they're proposed, and the government's got some history here with the old 296 proposal in terms of taxing unrealised gains that got knocked on the head. And that didn't make a lot of sense. It was contrary to everything in, the tax world in terms of taxing unrealised gains. And hopefully common sense, well, I don't know if it's common sense or what drove them to make that change. I'm starting to think there's not a lot of common sense, but it was changed. So, look, I think there's things in the proposals in this budget that are just as silly. And so I wouldn't be surprised that, they're not going to be enacted into law as they're proposed tonight. I think I've got a high level of confidence with respect to that. Whether the changes will be material, I don't know, but I think it will certainly change. So let's not jump at shadows, but let's get into, the major changes. And there's really three, of course: capital gains tax, negative gearing, and taxation of trusts. So let's get into it. We'll talk about them on Thursday. Mina and I are hosting a Q&A on YouTube. I don't know how many questions we'll be able to answer. We'll try and get through as many as possible. I suspect there's so much there that there's so many questions. But anyway, we'll be able to share at least our initial thinking around these, three big changes on Thursday. And so if you'd like to join us, the registration link is in the show notes, and I hope you can tune in at 12:15 this Thursday. So let's get into it. Let's start with the changes in capital gains tax. So, and these apply to all assets. And this change just doesn't affect property investors. All investors, investing in ETFs, direct shares, property, commercial property, whatever it might be, whether that's through a family trust or through in individual names. Of course, capital gains tax discount doesn't apply to companies, so no changes there, and no changes to self-managed super funds, or super funds in general, I should say. So what's happening? Well, from 1 July 27, so start of the financial year after the next one, the 50% discount will be replaced with the old indexation methodology, and a minimum tax of 30% will apply to the gross capital gain that remains after indexation. So normally what would happen is that gain would be taxed at your marginal tax rate. And so if you didn't have, if you had a very low income, less than $45,000, then you're probably going to pay 15% tax. Well, that doesn't apply anymore. You're at least going to pay 30%. Now, for most people while they're working, that's not a big deal. They would already be at the 30% marginal tax rate. But for people that, will wait to sell an asset after retirement or stream that capital gain to a beneficiary on a lower tax bracket, that's obviously going to impact them. So there's some transitional arrangements which impact existing investments. So gains continue to receive the 50% CGT discount up until July 27. So we've still got another year under the old system. But from 1 July 27, we draw a line in the sand. And from then on, we're taxed using the old indexation system with, again, that minimum 30% tax rate. And surprisingly enough, that applies to pre-CGT assets. So anyone that owns an asset that was purchased before September 1985, the current legislation says there's no capital gains on that asset. Well, now all those assets will be brought into the tax net. So taxpayers will need to obtain a valuation of assets or use the apportionment formula that the ATO is going to give us, which I imagine will be apportionment based on days, or you can get a valuation of the asset as at 1 July 27 so that you can apportion the two treatments. It's going to become confusing, but I guess the advantage for existing investors that have planned based on existing tax settings, at least up until 2027, nothing changes. Based on what's proposed, it's really about future capital gains. But here's the big carve out. The carve out is for new builds, newly built residential dwellings. Investors can choose between either the 50% discounts to the old system or use the indexation with the minimum 30%. I can take a guess what most investors are going to use. Of course, the old 50% discount approach. There's no change to the main residence exemption. So, investing in your home, and I've called it live investing. I've done a couple of podcasts about this. Starts to become more attractive when you've got higher capital gains tax. There's some small business CGT concessions, which are very generous for business owners that sell an active asset, including their business. So they remain, which is kind of interesting because I think that they're pretty attractive, and I would have thought they would have been the easy ones to kind of trim back. So what does this really mean? Well, again, it doesn't kick in until July 27, but what it really means is that the effective tax rate on capital gains tax at the moment tends to be around 20 to 23%. You might get it down to 15% if the gain's low and you don't have much in the way of other, taxable income in the year that you crystallise that gain. But I think for the sake of this conversation, we should measure the current settings at 20 to 23%. Well, for high growth assets, and let's be honest, we all want to invest in high growth assets, compounding capital growth. That's how we build wealth. So I think under that context, we should have that discussion. There's a bit of selling in the budget papers to say, oh, look, the indexation method isn't that different to the discount method. And that's true for lower growth assets because obviously the growth percentage is closer to inflation, but it's just rhetoric. So ignore that. My modelling that I've done over the last couple of months, it's the effective rate increases to about 30 to 35%. So it's a 50% increase in tax payable on capital gains tax for all investors after 1 July 2027. And now because we have the minimum 30% tax, it means that sometimes we will take the view to say, look, let's not sell an investment property now while we're working. We're going to retire in a couple of years' time. Let's sell it then when we don't have any other taxable income. Well, that's no longer necessarily an attractive option. The other thing too, with respect to having family trusts and be able to stream capital gains, that's because we've got a minimum 30% tax that we need to pay on capital gains. That's not really an option either. So really what the government's asking us to do is really make friends with paying 30% of whatever capital gains we make out in tax. Okay, let's talk about the second major change, which is change to negative gearing. Now, this only applies to residential property. So this doesn't affect share investors at all. We can negatively geared with shares, and I've done a couple of podcasts recently about lump sum share investing, how to construct an ETF portfolio. I've got one coming up using internally geared ETFs inside super. So, negative gearing is still achievable, just not necessarily with established property as proposed. Remember, I should highlight that. These are only proposals. So what has been proposed is from 1 July 27, if you buy an established property, you will only be able to offset your expenses against rental income and capital gains from residential properties. If you don't have any surplus income or capital gains, you will have to carry those losses forward. So no benefits really from negative gearing. And that change applies to any properties that are purchased after 7:30 last night. So if you buy a property today, for instance, on a contract to sale, you will still get the negative gearing from settlement through to 1 July 2027, but after 1 July 2027, you won't get that negative gearing anymore. Properties that were already owned on budget night, including those that, if you've entered into a contract to sale but it hasn't settled yet, will continue to get negative gearing on those assets. So they're fully grandfathered and there's no time limit on that grandfathering. Now, these changes as proposed apply to individuals, partnerships, companies, and most trusts. So excluding some trusts like self-managed super funds, for example, their trusts as well. Now, the exception is if you buy a newly built dwelling. And the definition of a newly built dwelling is one that adds to housing supply. So if the property was constructed on vacant land, of course, that's a new dwelling. It's adding to housing supply. If you demolish a house and build 2 townhouses, you're adding to supply, or demolish a family home and build a block of apartments, of course, that's adding to supply. If you demolish a family home and just replace it with a new family home, that's not adding to supply. That means you won't be able to negatively gear that property. But that negative gearing benefit only stays with the initial owner. So if I go and buy some vacant land, build a dwelling on that land, okay, I can claim the negative gearing. If I then go and sell that to another party, they will lose the ability to claim that negative gearing on that property. And so me, as someone that's built that original dwelling, not only do I get the negative gearing, but also get to choose the old 50% CGT discount methodology as well. So there's lots of problems with having different taxation treatments for new dwellings versus existing, and we'll talk more about that on Thursday. And New Zealand's a perfect example because they've done this before, so we can kind of learn from what's happened there and whether it really improved home ownership in New Zealand, whether it really made it easier to buy, and all those sorts of policy objectives. At least that's what the government's telling us. But the challenge is there's going to be lots of challenges with it, but as you can imagine, developers will be all over this. They'll be very keen to sell this idea to investors. But the tax treatments or benefits to the initial owner of the person that constructs that dwelling or dwellings will probably be priced into the market value, right? Because if I'm going to get this asset, those taxation benefits are unique to me. It's something we're going to need to be really careful about. Notwithstanding, I've spoken about buying or investing in new build areas. They tend to lack the supply demand fundamentals, but also we will go through on Thursday, what does it mean if we have no negative gearing for established dwellings? What does it mean from our perspective in terms of investing in those assets? Does it now mean that they're no longer an attractive vehicle? So again, we'll be talking through this on Thursday, probably too difficult to get through this. There's lots to get through tonight, so I'm recording this on Tuesday night, but we'll certainly get into it in more detail on Thursday. So negative gearing essentially abolished for any new property investors that invest in established dwellings. But thankfully, existing investors, those lucky enough to already own an investment property as of today, even if it's under a contract to sale, are protected from those changes. Now, probably the most egregious change announced in last night's budget is the minimum tax on discretionary trusts, which are going to affect a lot of self-employed people, but also a lot of people that have accumulated assets in trusts. I've spoken about it many times in terms of holding a substantial share portfolio in a family trust. Now, of course, we've got to see the legislation, but essentially what's going to happen is that the trust will calculate its taxable income for that particular period, that particular financial year. The trustee will then pay 30% flat tax rate, and then the trustee will then make an election to distribute that profit in that particular year, just like it always does, and that credit for the tax already paid follows through to the beneficiary. That is a non-refundable credit. So if the trust gets, if it's an investor in shares, for example, the trust, and it gets imputation credits, that's okay. It can use those imputation credits, so they're not lost. But then what will happen is that it will turn into a trust credit, not an imputation credit, and that it will be non-refundable. So if I distribute $20,000 to someone that has no other taxable income, normally they wouldn't pay any tax on that income. Well, with the proposed arrangement, they will pay a flat 30%. Now, the big problem is corporate beneficiaries, and this is where a company is a beneficiary of a family trust, which again is a very common structure for self-employed people. A corporate beneficiary will not get a credit for the tax that is paid by the trust. So the trust will pay 30%. It will then distribute into a corporate beneficiary. It won't, because you just wouldn't do it under this arrangement. But if it did, then the company would pay another 25 to 30% tax. So the total tax on those distributions then would be between 55 and 60%, which is insane, of course. And if that became legislation, of course, no one's going to use corporate beneficiaries anymore. Now, there's some income in family trusts that's excluded from this arrangement: primary production income, so farming, certain income relating to vulnerable minors, any amounts that are subject to non-resident withholding tax, also pre-existing discretionary testamentary trusts apparently excluded from this arrangement as well. Now, there's still a bit of detail to come with these arrangements as well. So we've only got sort of high-level detail, but there's not very much good news today. There is a tiny bit of good news. There will be rollover relief and transitional periods. So for 3 years, what the government has said, there will be some CGT rollover relief for restructuring. So if this does become law, what you'd have to do is then speak with your holistic accountant and then restructure whatever investment or business income structures you might have to navigate these arrangements as best as you can. So family trusts for business owners have been used for decades, really, to stream income to non-working spouses, adult children, maybe self-funded retiree parents. Really common sort of situations. Well, if this gets across the board, if this gets legislated, those days are probably limited or over. Now, I guess a couple of observations to share that, if you're distributing to beneficiaries that already have an average tax rate of 30%, so that is that you're taking most of the profit out of your business income structure, it's probably not going to affect you too much. You could employ family members on a commercial basis and pay them a salary from a business rather than them receiving income via distributions or dividends. So that's always possible. Or you can, as I said, use the rollover concessions. We don't know what they are yet, and restructure. There's always a solution here, maybe not one that's going to get us back to where we were, but there's always something that we can do to sort of navigate these changes. And again, it's something that Mina and I, particularly in the Holistic Accountant podcast, which is more aimed at self-employed individuals, we'll be talking about in more detail as the months and weeks pass. I also should note that the small business CGT concessions are still in place. So, we might not use the other concessions. We might use the CGT concessions, reset the cost base of the business, restructure it. It might not be necessarily the end of the world. This is the most egregious change because taxation of trusts and treatment of trust income is entrenched in common law principles. So this is a substantial change, much like and very similar to, I would say, taxing of unrealised capital gains. So I think a lot of water has to go under the bridge in respect to the taxation of trusts for this to actually become legislation, to become law. So again, if you are caught by these changes, don't panic, firstly. This is only proposed, and of course I can't predict the future, but I certainly wouldn't be surprised if this didn't get through as it's been proposed last night. Okay, so there's a couple other smaller changes that affect individual taxpayers. So from the 28 financial year, there's a what's called Working Australians tax offset of $250. A big deal. I don't even know why they would even make that an announcement, a budget announcement. I mean, it's overshadowed by much more significant tax liabilities. So big deal. But it's there in a few years' time. From financial year 27, there's a $1,000 instant tax deduction. This one's a bit of a no-brainer. So people that have work-related tax deductions tend to keep substantiation, so receipts and so forth. Just streamline that, and everyone gets a $1,000 tax deduction, and you don't need any substantiation. So that's good. Charitable donations, union and professional association fees, and other non-work-related deductions still need to be itemised, and you still need to have substantiation for those things. And the Medicare levy low income thresholds will be indexed again. That happens every year. So there's different indexes for singles and families and so forth. That's in the blog on the website. There's nothing really new there. They're going to remove the private health insurance rebate. So people older than, well, not the full rebate, I should say, for those that are aged over 65, depending on their individual and family income, they potentially got a higher private health insurance rebate. Well, they're going to get rid of that higher private health insurance rebate. That can range really from 4 to 10%, I believe, something in that order. So that means that over 65s will pay higher insurance premiums. As you can see, there's not a lot of good news in last night's budget. Let's talk about business taxation. So again, for self-employed, I'll run through this pretty quickly because most people that listen to Investopoly podcast aren't self-employed. And it's really the domain of Mina and my podcast, The Holistic Accountant. But anyway, the $20,000 instant asset write-off is to be made permanent. So that's for businesses that buy an asset up to $20,000. They can depreciate that asset in 1 year, in the year that they purchase and use that asset. That's been a feature really since COVID, and they've kicked the can down the road on that one, so they've extended it. So that's a permanent feature. I would say big deal. The next one is a loss carryback reintroduced. So this was also a feature in COVID. So this is where a business entity makes a profit 1 year, and then for whatever reason, there's a downturn in business the following year and they make a loss. Well, they can claw back some of the tax that they paid last year to sort of get them through that difficult loss-making period, hopefully. So the loss carryback, that's kind of good and makes a bit of sense. Again, in the scheme of things, given all the other changes and the capital gains tax that business owners are now going to pay, that's not necessarily going to soften the blow. Also, there's some provisions for startup companies that are making losses to be able to claw some of their PAYG and fringe benefit tax back as well. So I guess making sure that the government's supporting new enterprise, but I don't think they are. Anyway, it's another feature of the budget. And the next one is monthly PAYG installments. So normally what happens for self-employed entities, they'll pay a installment every quarter through their BAS towards their tax bill for that particular financial year. The challenge with quarterly BAS is that, it can become a cash flow challenge to sort of monitor, what is quarantine money for future tax liabilities versus retained profits. And so the government's going to introduce sort of monthly payments for people to sort of opt into that, and taxpayers that have a history of non-compliance, they're going to get them onto paying monthly as well. Large taxpayers already pay monthly instalments, PAYG instalments anyway. That's kind of good, I think, for business, because I think it helps them kind of manage their cash flow and again quarantine that money so they don't end up with a huge tax bill at the end of the financial year when they lodge their tax return or as they approach their BAS payments. And the final one is the wind back of the electric vehicle fringe benefit tax. So there's no fringe benefit tax as it stands if you buy a electric vehicle, and that's if you're a PAYG employee and you salary sacrifice it. There's no FBT tax. And also if you're self-employed, well, they're going to start winding that back between 27 and 29. They're going to pare back that benefit. And then after 2029, there's no electric vehicle fringe benefit tax, which kind of seems a bit silly from a government that sort of prides themselves on, advancing, climate change initiatives. That the electric vehicle thing's been pretty popular. You would think that's a positive outcome of a policy, not a negative one. But I guess that they're trying to find ways to save money in the budget. Whether you believe them or not, that's another thing. Okay, so let's wrap it up then. So none of these changes are law yet. As I said, it still needs to go through both houses of parliament to become law. It's important to recommend that law as proposed or announced rarely goes through unchanged. And in fact, some proposed laws never actually become law. And we saw that recently with Div 296 with the tax that applies to super balances above $3 million. So the proposed change are aggressive. A lot of them are very aggressive. There's going to be significant unintended consequences by a lot of these policies, and we only need to look to New Zealand's experience for some of those. And so I think it's going to be heavily debated over the coming weeks and months. And for that reason, I think that there's a high probability that some of these measures won't be legislated in their current form. So let's not become too concerned at this stage. It's certainly something for us to talk about and think about, and we'll certainly be doing that. But, don't become too concerned initially, and certainly don't make any changes off the back of those announcements. It's also important, as I discussed in a recent episode, tax is only one of many considerations. Of course, we need to reduce the taxation drag on investments and, our income as much as possible. So I'm not diminishing the importance of that. But there's lots of other things that we need to make sure we get right. Using evidence-based strategies, holding quality assets for a long time, using gearing sensibly, managing cash flow prudently. All of those things are, I would say, just as important or often more important than minimising tax. So it's only one sort of ingredient or component to really achieving your goals. And tax is always going to change. That's the other thing too. We've got to reconcile that. If you're going to be an investor over the next 10, 20, 30, 40 years, you're going to experience many of these sorts of budgets. I think this is probably the most significant budget in the last 10 years, and maybe at least top 3 in the last 20 years perhaps. So I'm not underplaying this one. It's got some substantial changes in there. But, nothing ever stays the same. We've been through the introduction of CGT in 85, GST in 2000. There's been lots of changes along the way, and investment markets navigate, advisors navigate, investors navigate these changes. They're not insurmountable. They're not going to change the rules of investing, to my mind. It's really just about pulling them apart and understanding how they do change strategies. The only proviso there, if there is no negative gearing to buy established property, that could move the dial on that tactic in terms of building wealth. So we'll talk more on Thursday. As I said, hosting a live stream at 12:15. We originally planned for it to go to 45 minutes. I won't be surprised if it goes an hour or even a little bit longer. And if you would like to join us for that session, you can register. The link is in the show notes as always, and we look forward to you joining us there. We'll try and get through as many questions as possible, but as you can imagine, I'm sure there's going to be heaps of questions, but I think they're all going to be kind of the same theme. How does it change my strategy as the investor? How do I navigate these changes? And that's certainly what we're going to focus on, as well as I think unpacking, some of the unintended consequences of these things. I'm also going to be on James Kirby's, the Australian's James Kirby's podcast next week, which usually comes out also on Wednesday morning. So we normally record that one on a Tuesday. So again, we'll be discussing all the announcements that were included in last night's budget. Okay, I might leave it there for now. As I said, just a reminder of Thursday's event. That'll be a good one, I'm sure. And until next week, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.